Welcome back. Taking a look at the trading action this week, we see here the S&P 500. Every blue dot represents a closing price for the day. The red line represents a low of the week, the green the high, and we closed right near the high of the week, right around S&P 500 4040, which is a positive signal. We can see here, taking a look at a longer term picture, the red line represents each week's respective low. The blue is each week's respective high, and the yellow dots show each day's closing price. We did close right on or right near the high of the week. Now, going back to January, we saw the uptrend was really shown or developed as a result of the stocks closing near the highs of the week. And conversely, late December, the stocks closed near the lower end of the week, and that really developed into a downtrend. So today's close on the blue line, on the high of the week, really is a positive sign, but maybe not so much. We see here the red line represents the S&P 500, and the white histogram bars again show us the percentage, the Friday close as a percentage of the week. So when we see a histogram bar all the way to the top, like we do today, that shows us that the Friday closed on the high of that week. That also occurred in January. Histogram bars are right near the high, and the red line, the S&P 500, went higher. So again, we thought at first maybe it looks like a positive sign, but we'll take a deeper look, maybe not so much. Here we see every yellow dot represents one stock in the S&P 500 index. It's shown on our RSI, Relative Strength Index. The center line is 50, the lower line is 30, and the upper line is 70. And what we see here is a very equally spread out market. There's just as many stocks below 50% as there are above. There's no clear trend. We see here the histogram bars show us the count, the number of stocks in the index at every respective relative strength bracket. So, for example, we have here 93 stocks in the S&P 500 that have an RSI between 40 to 45. We have around 88 stocks with an RSI reading between 45 to 50. In fact, the vast majority of the stocks in the S&P 500 have a relative strength index of between 40 to 60. It's right in the middle of the range. We see here every red dot represents one stock in the index, and this is plotted on its own 52-week range. So we see a market that's very spread out. You have just as many stocks near the lower end of their annual range as we do at the upper end of the range. Here we see the count, the number of stocks trading, for example, at the 50% level of their annual 52-week range. We have just as many stocks trading near the lower end as we do at the upper end. No clear trend. And that does present a level of danger for investments because when there's no clear trend, any stock that goes up easily could come down. In a strong trending market, if we buy a stock that's strong, it has a good chance to continue to go higher. These are the top 10 industries shown by the S&P 500. It's a very mixed story. Recreational products, plastic products, professional services, forest products, no clear trend. When there is a strong trend, we may expect to see the technology sectors lead the market higher, or a specific theme, so to speak. There's no theme within a trend. These are the bottom 10 sectors within the S&P 500. Again, no clear trend. Water supply, biotechnology, mining, there's no clear trend. And again, that represents a very dangerous situation. Here's what the bond market closed like. The 6-month bond pays a 5.12% yield. The 12-month, the 1-year bond pays a 5.00. The 10-year pays a 3.96. So we have a much higher yield on the 1 year than we do on the 10-year. That's the definition of an inverted yield curve. Again, the 1 year pays 5.00, the 10-year pays 3.96. That's a 104 basis point inversion. We see here the red line represents a 1-year bond, the black line represents a 10-year bond, and we have a very wide spread between the two. These histogram bars over here show us how wide that spread really is. The inversion took place around July of last year, and we see it's very wide now. If you take a look at some of our prior videos where we talk about the history of the inverted bond market, we show in 2001 and 2008 a sideways bond market where the short-term maturities were above the long-term and they traded sideways for quite a long time. This could persist. Over here, this is the 1 month change in bonds. This is how the yields of every respective maturity have changed over the past month or so. We see the biggest change occurs in the midterm bonds, the 3, 5, 7-year bonds. Those have increased. Those yields on those medium-term bonds have increased around 20, 24%. The short-term bonds, like the 1 year, have only gone up around 9%. The 10-year has gone up around 20%. So we see a lot more growth in the yield on the medium and long-term bonds than we do in the short term. What does that mean? It means that the black line, the 10-year, is going up faster than the red line is. It looks like the contraction is starting to, or the inversion, I should say, is starting to contract. Here's another look at it. So we see, for example, the 30-year bond is this dotted line at the bottom. This dotted line at the top is the 1 year. Notice how, going back to the beginning of February, the 30-year paid a 355 and now pays a 403. That's around 50 basis point difference. Meanwhile, the 1 year paid a 479 and now pays a 504. That's about 30 basis point difference. So the longer term and really the medium term, like the 5-year, that is accelerating to the greatest extent. And we see also, of course, on the longer term scale as well. So we see much more of a change in the medium term and long term. Now, what does this mean? Do the long term maturities eventually overtake the short term, and what does that mean for stocks? Well, in 2001 and 2008, when the inversion disappeared, that was actually a very negative moment for stocks, and stocks ended up going down. But that's only one particular situation. We're going to have to see how this plays out. But we should make note that while the stock markets appears to be very boring in the middle of a trading range, we see a lot of change and a lot of activity in the bond market. And we're going to continue to watch this development very closely. And we'll be sure to update you with any significant changes along the way. We hope this has been helpful. We look forward to seeing you back soon.